Diversification means that at any given time, there's always going to be something in your portfolio that you are happy with and something that you're unhappy with. That's how diversification works.
Yes.
If you are really happy or really unhappy with everything in your portfolio, guess what? You're not diversified.
Welcome to the Money Alchemist podcast. I'm your host, Ben Jones.
And I'm Brent Gargano.
And today we're here to talk about all the things that changed over the past couple of weeks. So we've had some big things hit the headlines. So one of those we were talking about earlier was this big Cintrini report that came out. So for those of you who don't know, Cintrini Research is a big research firm. Do they manage money too? I think they manage money. Am I?
Yeah, I don't know. I mean, I think just to set the stage for the conversation today, I mean, markets have been, the last 6 months have been crazy. Mm-hmm. Yep. I mean, we started talking about this back in like October. Mm-hmm. I think with what we had an episode where we talked about some of the cracks that were showing up in private credit.
Yep.
And it was kind of leading to a fall off on some of the AI companies.
Well, I don't know if it was just private credit. It was also, we were talking about the massive ramp up in private equity as well. You know, it's just completely sucking the air out of all small cap.
Well, if I remember right, so a little bit of kind of taking a step back. Last, what was it, September, October, I think we had Oracle came out to raise a bunch of money for some AI spend that they were going to do, and they ran into problems raising the capital. Yeah. And that
someone did the math and realized OpenAI didn't have the money to buy.
Well, and I think that really began. So you and I, as we've led up to this podcast, we've been sitting here playing around with some charts, and what we've really noticed is that if you look at it, the software sector, I mean, what's been going on in the tech market this year it seems like a software story.
Yeah.
And really, if you look at the peak, it was like October 29th that we kind of had that private credit moment, and it started to raise questions about really the validity of the economics of some of the AI stuff, and software has just gone off of a cliff. Since October 29th, software is actually down.
That's okay. And by software, which you're talking about are companies that primarily design and resell software, specifically software as a service. Microsoft would be an example of that with their Microsoft Word, Microsoft 365.
Yeah, so I'm just measuring this based on the iShares Expanded Tech Software Sector ETF, which is ETF IGV. Their top holdings include Microsoft, Palantir, Oracle, Salesforce, Palo Alto, et cetera, et cetera. So names that we've heard of. If you look at this ETF since October of last year, the end of October, it's down almost 35%.
Yeah, 1 year return down 22.21%. So, you know, that's pretty brutal.
And before this, we were talking about, you know, I think what's so fascinating here is Microsoft. You mentioned it. Microsoft is probably the most the most well-known company in this mix. Microsoft stock is off by a lot. I mean, I think Microsoft stock peaked over $500. It's down in the 380s right now.
Let's see here. 6-month return on Microsoft is down almost 24%.
Yeah.
Yeah.
Yeah, and I just find it so interesting because if you go back to what we were talking about last year, there was so much fervor around concentration in the markets. We touched on this last podcast episode, but I just think it's worth highlighting again, which is that the gripe last year was that the S&P 500 was really, really concentrated in the Mag 7 stocks, and that eventually that was going to mean the S&P was going to go through a pretty bad patch as that concentration worked against it. So I pulled up, before we got started here today, I pulled up a chart of the Mag 7 stocks, as we call them, the 7 dominant stocks that made up the S&P. And if you actually look at this, what you see is that on average, if we measure this based on the Mag 7 ETF, Mag 7 as a whole is down like 9.5% year to date. Mm-hmm. So if you were buying all the biggest companies in the S&P, you're not feeling too good. The S&P, you want to know how the S&P is doing?
Yeah, it's positive.
It's flat. Basically flat. And then S&P X Mag 7 is up like 3.5%. Mm-hmm. So I just find it fascinating because, you know, all the doom and gloom was, well, when these Mag 7 get, you know, some volatility, there goes the index. And I think what we're seeing is that it's not quite that easy. Like the index is more durable than we realize. Or that we give it credit for.
Yeah. So this Cintrini Research report came out. I didn't read it. You started to read it to me, and my eyes kind of glazed over because it's written in the future tense, like where like the year is 2028, and all doom and gloom has come upon us, and this whole AI disaster scenario is played out, and the rich are super rich, and the ham and egg crowd, or they can't even afford the ham and eggs anymore. So it to me kind of sounded a little bit like fear porn, honestly. So we were talking coincidentally. So, okay, anyway, let me take a step back, explain the whole Cintrini report. Like the thesis, as I understand it, was that you actually worded this. You said AI is so good that it's bad, and that it's going to completely take over any sort of job. I've actually heard Elon Musk even said this. He says, unless your job is moving atoms, you're going to be replaced. And I don't necessarily deny what he's saying could be true, but it just sounds kind of like BS. We actually had breakfast before this, and we met a couple software developers that I know, and they pulled us aside and said, "Hey Ben, how you guys doing?" And we asked them the question, "Hey, what do you think about Cintrini's report that software's dead?" And they, especially the cybersecurity, and they said the complete opposite. They think that actually it's going to, it's going to demand for software is going to be higher than it's ever been.
Well, just taking a little bit of a step back for the listener, this Cintrini report. So today is February 24th. Yesterday was Monday, and this report came out over the weekend. So over the weekend, this Cintrini Research published this. I don't know how many pages. It's a long report, and it is written from the perspective of a financial reporter writing something in 2028 about essentially the AI collapse of 2026.
Well, it's not the AI collapse. It's the worker collapse caused by AI.
Right. So it just reads, it's very ominous. I mean, I'll say reading it's a little unnerving because it talks about things, I'll just open up the way that they open. It's written as if June 30th, 2028, and it opens by saying the unemployment rate printed 10.2% this morning, a 0.3% upside surprise. The market sold off 2% on the number, bringing the cumulative drawdown of the S&P to 38% from its October 2026 highs. Traders have grown numb. 6 months ago, a print like this would have triggered a circuit breaker. And then it goes on to say the euphoria was palpable. By October 26, the S&P 500 flirted with it. It talks about how the markets are just going to pump up, and then essentially the whole bottom is going to fall out as the consumer has no ability to buy anything, and the companies that we're investing in effectively become obsolete as AI just works around whatever competitive advantage they have.
Yeah.
I think it's dubious. I don't buy it, and the reason why our friend brought up a good point. We asked him, it's like, what do you think about cybersecurity and the fact that we're going to have all these AI agents? He says, okay, imagine you have an AI agent and it's running your email account. How does it know what a scammer email looks like? It's just going to click the link and pay a bill. It's going to click the link and pay a bill. It has no context as to who should be sending you emails. What conversations have you had? What's legitimate? What's not legitimate? So there's a limit to how much we can outsource these AI.
Yeah. So like in essence, if I told my AI agent, hey, go watch my emails and monitor them and respond and take action to what we get, and then I get some phishing email from XYZ person, hey, here's an invoice, please click here to remit payment, and as a human that's been living my life on a day-to-day basis, I can kind of recognize that seems a little bit sketchy, and maybe I'm not going to do it. But the AI might just say, oh, that's a bill, and it doesn't know some of the added context. So who knows? Maybe it'll just pay it. But their point was that we're not going to need less. Their point and the question we asked related to cybersecurity stocks, because yesterday cybersecurity stocks sold off very hard. Like CrowdStrike stock was down like 10% yesterday. And so, and the notion was this report essentially asserts that things like cybersecurity are going to become unnecessary as AI is just able to replace the role of the cybersecurity companies. They literally laughed at us this morning when we brought this up. Their response was that
it's going to be a complete opposite. And I agree with that because we live in a world of cause and effect. And I think we have a habit of looking at this world like, oh, we're going to be able to fully outsource our agency. There's nothing left to do. You don't think that that's not going to have a consequence that will require human intuition to respond to? Say what you will about these AI chatbots, and we're going off on a tangent. We probably should circle back and finish the news breakdown here. But the fact is, these things aren't alive. People anthropomorphize everything. They think, they think, oh, these chatbots are alive. And I talk to people want to marry these things. I read a story about this woman who was tricked into thinking that her soulmate was going to be found because the ChatGPT was going to introduce this person to her, and that she was actually 42,000 years old or some kind of malarkey like that. And she had fed all this information, whether she did so consciously or subconsciously, I don't know. But this thing created like a feedback loop of wild fabrication that ended up with her being abandoned by her soulmate, who she thought existed but wasn't there, and they ended up not showing up to this park bench or whatever. Anyway, I'm just like, wow, true story. I cannot believe that. But
I saw a story. Here's another, just to kind of, I know you said we're off track, but just to go along with that, I saw a story of somebody AI faked like they were Brad Pitt, and like catfished some person into basically giving, like, they had a relationship, and apparently Brad Pitt pretended that they needed a bunch of money for surgery or something because there was like their money was this lady ended up getting defrauded out of like a ton of money, believing that she was giving money to Brad Pitt, who was going to marry her.
So how is that not a human problem? How does an AI help that? That is a problem that is only solved by humans, not some AI software program. So let's circle back and finish up on the news stories that have happened over the past couple of weeks. So obviously we had the Cintrini Research report.
There's no N in there. I looked at the...
That's my fault. I spelled it wrong. Anyway, I should be aware of that. The other thing was the breakout of violence in Mexico is kind of wild. So you mentioned that. I didn't even know about that.
Well, this is like not market stuff in some ways, but like I'm pretty sure that we're about to like overtake Iran.
Well, it's germane to the context of this conversation. We're going to talk about tariffs. So that was the final news story that hit. But I think it's relevant because Mexico is one of our largest trading partners.
Well, my understanding is that throughout this tariff tantrum, we'll just call it, Mexico and the U.S. have gotten pretty tight. And so as a part of a result of that, as a pressure of Mexico to put pressure on their cartels, sounds like Mexico just killed one of their highest cartels, if not their highest cartel leaders over the weekend.
So it almost seems like a situation of chaos by design. And I wonder where that's going to head. Whenever you have chaos like that, it just injects a whole lot of uncertainty. And especially with tariffs being kind of in limbo right now, do we really need more uncertainty in the world? Not that I'm a big fan of cartels, but they do bring some order into Mexico. So we'll see what happens. I think that there's going to be a lot less travel to Mexico as a result of this. And we do wonder to what extent we're going to see an acceleration to what they call friendshoring into Mexican manufacturing. So it's something to keep an eye on. The final news story that we're going to cover today is our main topic, and that is the Supreme Court on February 20th. And I owe my listeners and readers an apology because I expected this ruling to be much later. So they actually accelerated it and ruled on it in February, which is good. I think it's a good thing. But they, in a 6-3 ruling, they ruled against the Trump administration's evocation of what they call IEPA. It's the IEPA. Yeah, go ahead and
the International Economic
Emergency Powers Act.
Yeah.
So they just call it IEPA. But they ruled it to be the evocation of that act to be a violation of the Constitution. So the IEPA, as they say, was kind of like the Infinity Gauntlet. It was like Trump's Infinity Gauntlet. It was like, his ultimate.
Well, it was his proverbial, pardon the pun, but it was his trump card.
Yes.
So he's like, you get a tariff and you get a tariff. What's that you said about Melania? You get double tariffs. Just signing tariffs however he felt. You remember the card he held up?
Oh, I'll never forget. Hey, Howard, go ahead and bring up the beautiful chart. I was watching that. I'll never forget that moment.
Yeah. I've watched it on YouTube. I had to go back and see it. Yeah, it is.
I was watching the market futures, like as he brought that chart up. And it was, we did an episode like 3-4 business days later about like market rebounds after historical, what are called waterfall sell-off moments like that. And I wish we could go back and revisit that. We probably should at some point because it was
yeah, well, we called it right.
Hindsight
we
2020. It looks like we were pretty spot on.
Yeah, we were. So, but it was a meme-worthy moment. And what gave him that power, that broad-based power to just unilaterally assign tariffs to countries, like making, we're calling $1 trillion decisions. I mean, the trade deficit with the U.S. is $1.2 trillion. So was this act, and it was very ambiguously defined. In this act, there is nothing that references the word tariffs at all. And that really ticked off some people. And it really ticked off this company here called Learning Resources. So this little company, unassuming shop here, of course, look what they sell. They sell a bunch of goods made in China here. Probably, this product here selling for $22 probably costs them like 5 cents to manufacture. Anyway, it's a company out of Chicago. They do something like $50 million in revenue a year. It's I think it was like one of the 12th largest toy manufacturers in the United States. They took issue. So they filed suit saying that the tariffs were unconstitutional. Supreme Court, I think fast forward how many months later, 12 months later, I don't know exactly.
It's been less than 12 months since the tariffs were put in, right?
And it's less than 12 months. So this made it through the courts really quickly. They agreed. They said, yeah, it's unconstitutional. The basic notion of this was if it's not explicitly stated in the act, if Congress doesn't explicitly state that you can or can't do something, then we're going to say you can't. So it basically assumes a negative. And so that was the ruling. Trump obviously was apoplectic about this. I forget the words he used to describe him, but he pretty much they fell short of calling the 6 Supreme Court justices traitors. Pretty much called him un-American. He was very upset about it because it was the thing that gave him the most flexibility. Now he's
Trump called the justices that ruled against him a disgrace to our nation and referred them as fools and lapdogs. I mean,
it was some pretty colorful language there, but obviously I think that it's called by the way, it's the major questions doctrine. Major questions doctrine. I don't know. These judges leave it to attorneys to name something confusing. Did you try to read the 170-page rule?
No, I mean, my understanding of the ruling is that, it's a little nuanced, because we hear tariffs and we just think, oh, tariffs on, tariffs off, but there are different kinds of tariffs. Mm-hmm. So this was only specific to the tariffs that fell under the IEEPA section of the code, which doesn't include like tariffs on like Canadian lumber and specific tariffs on like specific resources. Mm-hmm. It's just these blanket tariffs that Trump put in as essentially an emergency, a crisis. He essentially framed a crisis to then implement tariffs that arguably Congress needs to approve.
Well, it's not arguable anymore, according to the Supreme Court.
And then that was what happened is we got to decide like what's arguable, what does arguably mean? And now the Supreme Court has said, hey, really Congress has the power to put these tariffs in place. And so, but at the same time, so when the Supreme Court ruled, it wasn't like a unanimous thing. 6 of them said, okay, these are unconstitutional. 3 of them dissented. Yeah. And Brett Kavanaugh, one of the appointed justices from some years ago that Trump appointed, actually in his dissent kind of gave Trump the rule book on like what to do to get around these rules. Yeah,
and that what that leads to is now you see Trump out there in his speech is saying that, oh, we're going to charge more tariffs than ever. We've got more flexibility than ever. And then the response that people have is like, well, why didn't you go that route in the first place? Like, why take all this time to go this route, use the IEPA, get that torpedoed, and then, why don't you just evoke these other sections? So what they're going to go for now is kind of a stopgap solution. Is they're going to leverage what's called Section 122 tariffs.
Right.
So this is part of the Trade Act of 1974, and it's considered balance of payments authority. So, but it only lasts for 150 days.
Well, until it needs congressional approval.
Yes, and it's capped at 15%. And you mentioned the tariffs now are something north of 16, right?
Well, from what I've heard is that prior to the Supreme Court ruling, the average effective tariff rate was like 16%, and now it's come down slightly to like 14. But that's kind of the average rate, so it's all calculated. But that Trump has essentially maxed out his allowance on these Section 122 tariffs, slapping like a 15% universal tariff on goods. And he only has 150 days to do this. And I imagine if you're in the Trump team right now, you're working pretty hard to figure out like what your alternatives are.
Well, they kind of know what they are. So they're looking into right now what's called Section 301, which is part of the Trade Act of 1974, and then Section 232. That's where the steel and aluminum tariffs are currently applied, is under Section 232, which is part of the Trade Expansion Act of 1962. Actually, that tariff was codified all the way back in 1862, so it goes back quite a long ways. So both of these sections, Section 301, Section 232, are kind of enforced by different departments. So Section 301 is enforced by the U.S. Trade Representative. So, what they have to do is determine if a foreign country is engaging in unfair practices. So, and they have to do something like a 30-day study. I think the study can take longer than 30 days. There's a limit to how long that they can take. So it takes time. So they got to do a whole study. They got to figure out, okay, is this fair? Is this unfair? And then if it's fair, there's nothing the president can do. If it's unfair, well, now you can only have tariffs up to that balance point. Right. You can't use it. You can't say like what Trump would do is he would say, China did something and I'm going to, it's 125% tariff. So that threat goes completely away. The Section 232 leans more on the Department of Commerce, specifically the Bureau of Industry and Security, and they have to do something similar. But instead of measuring unfair practices, what they're looking at is what impact does it have on national security. So, like steel industry, for example, you don't want to gut our steel industry because, well, what happens when the U.S. can't make any steel? So, and that really is going to limit what the Trump administration can do. So this whole narrative that they're putting out there, they're like, we're going to be able to do more tariffs than ever. I think this ruling completely neuters the entire policy, personally.
Yeah. So what does it do to the Trump agenda?
I don't really think the Trump agenda was off to a good start in the first place. I mean, if you think about it, like let's say we're Tim Cook with Apple, all right, and we want to manufacture iPhones in the United States. That's obviously like what people think of when they think of bringing manufacturing back to the United States. What they're typically saying to themselves is, how do we get stuff out of China and into the United States? That's most of the time what people are thinking, because everything we have,
Well, we spent years. I mean, when I was growing up, the Republican side of the aisle was talking about globalization. Like, I remember debates.
That's a good thing.
I remember debates between like George Bush and Al Gore, where George Bush was talking about how we need freer trade with China because it was bringing the cost of manufacturing down, and that was a good thing. And it was like the Democratic policy was, or the Democrat policy was to. It was more of like the protect our workers here in America. It's just, it's so interesting how that's flipped in just my lifetime.
Well, it flipped with Trump.
Yeah.
That's, he's
more of a populist really than a traditional.
Yeah, which is crazy. And I think Democrats to some extent because of strategy. You got to differentiate yourself from the opponent. So but they took it to an extreme where they almost had to automatically do opposite of what Trump was doing. Anyway, I don't want to get down that road, but your question was, what does this do to Trump's whole,
like, does he have the leverage that he once had to negotiate?
He doesn't.
Right. He doesn't have the leverage. It's not toothless, but it's no more leverage than what, Joe Biden or Barack Obama had or George Bush before him. So, in fact, I do want to look at some of the numbers because one thing that the question I want to ask is, well, did it do anything? Did the tariffs, while they were applied, bring manufacturing back? Did any companies do anything? And the answer really is, when you look at the data, no. Now, there is some evidence showing that there's been a lot of manufacturing that's moved back due to friendshoring, but a lot of this happened before Trump's tariffs, with the CHIPS Act, but most of it had to do with COVID lockdowns, supply chain diversification. So it was kind of necessary for companies to friendshore, as they say. So, it's tough to argue like, okay, what percentage of these jobs that came back into the United States? For example, you had the Intel factory going in what's it called? Ohio. What essentially has happened over the years is manufacturing. So if you look at the Federal Reserve economic data here, manufacturing has just stayed steady. It's kind of flatlined since 2005. We saw this big drop off in the financial crisis, and it never recovered. It never recovered because companies, they shut down their factories, and then as they came back online, well, it was a lot cheaper to reactivate stuff overseas because of wages. So, and then really the United States manufacturing base has never really recovered from that. And then the Trump agenda really hasn't done much, to push us forward. So, and if you think about it logically, Brent, like Tim Cook at Apple, how do you bring iPhone manufacturing back to the United States? Well, it's not just you don't just build a factory and call it done. You got to put people who know what they're doing inside the factory. You got to have skills. You got to have education. I know nobody personally that knows how to build an iPhone. Do you?
Maybe not personally.
Yeah.
There's a kiosk at the mall that can probably do it.
So there's a skill set that is integrated into these manufacturing economies like China that's very difficult to decouple from. And so if Tim Cook at Apple, he's not just doing it because it's cheap and it's better for margins. He's doing it because, like, what are the options? So, but I don't think that's always going to be a thing. So my point I'm trying to make is that it can't be done. My point is that it can't be done in a 4-year time frame. And whoever was going to follow up Trump.
Yeah, I do agree with that. It's like these kinds of things take longer than a presidential cycle to implement. Mm-hmm. And a lot of these companies realize that before their projects are finished, that they're going to have a different regime.
Well, there is this reshoring initiative. It's like this website, reshorenow.org, that's been going on for years. And they produce all sorts of data on bringing stuff back to America, like manufacturing back to America. So there is always been, not always, but since really the gutting of American manufacturing, which kind of happened in the early 2000s, there's always been a strong desire to go back and bring it back into the United States because it's more economic. It means more economic security. It means a more stable middle class, and it's also good for just defense as well, as we learned in COVID.
But is it like do we want more people? Like I remember when we first had this conversation around tariffs, and the kind of joke online was, do you want a bunch of people in America making Nike sneakers? Like, is that really the job that you want here, or do you want higher skill jobs that are higher wages?
In a perfect world, we would want everybody to have high-skilled, high-wage jobs. But I don't know about you, but not everybody's – people say everybody's created equal. I'm like, I don't know. It's not my observation. There are a lot of people that just lack the brain power to do certain high-level skill jobs. And I don't think that we're ever going to be away from that. I think every economy is going to have its crowd of folks that just need a 9-to-5 hourly wage, turn the screw kind of job.
Regardless, my perspective is that here in America, we want better jobs in general.
Yeah.
And, we want our people here in the U.S. to have healthy incomes. And I don't think we want to compare our middle class to the middle class of China, in terms of what their basis of living and basis of income should be. And we do live in a globally connected world. And so whether we like it or not, you're always going to be comparing the cost of producing something in the U.S. and paying U.S. workers against the cost of producing something in XYZ, name another third world country where you can pay a lot less.
Yeah.
And, I'm kind of one of these believers that economics is kind of like gravity. You can try to fight it, but eventually you're going to fall on your face. And I just think there's so many situations like this where like we as the government or as a people try to pretend that we can just force the economics of something because it's not right the way that it is. And I just don't know that that's ever going to, it's always going to be like fighting an uphill battle, so trying to get Apple to, and I'm just making an example here. I don't know what Apple actually pays per hour to build an iPhone. I'm guessing it's not a whole lot in one of these.
By the way, I quick anecdote. Can you guess, back to the whole tariffs cause inflation debate, can you guess what the cost of an iPhone, a brand new iPhone 16 Pro Max was in 2024 before the tariffs?
Oh, I don't know, maybe $1,200.
Bingo, right on the money. Can you guess what that same equivalent, the price is now?
I'll say $1,400.
$1,200.
Oh, well, great.
Zero inflation. So, in fact, inflation data has come down. Anyway, I derailed you.
Yeah, I could go on a while about that too, because let's not go there yet, but let's circle back to the Fed. I think there's a lot going on internally to the Fed, and the Fed is really split right now. And one of the beliefs right there is about where inflation is and where inflation is going. And I think there's a lot of people conflating the idea of high prices with high inflation. And those two things aren't the same. But anyway, back to the Supreme Court ruling. One thing that was I don't know about it intentionally. I guess it would probably be intentionally left out. I assume they were pretty intent on things, but they didn't give direction as to what's going to happen with the tariff revenues that have already been collected.
Yeah.
So originally when we were talking about these tariffs getting repealed, the idea was, well, if the tariffs get repealed, then the government is going to have to pay back the money. That's not how this played out. So now all of that has been pushed down to lower courts. And so yesterday we actually saw the first lawsuit come out. FedEx is now suing the government for their tariffs that they've spent. Yeah, and I suspect we're going to see that work its way up back to the Supreme Court. And we're going to have...
Yeah, and it's not a small amount of money. Per USDebtClock.org, I got on the screen here, almost $375 billion in tariffs collected.
The government doesn't have that money as it is.
Now, some of that wasn't collected under IEEPA, but...
I think I heard a stat that was like 170 billion that had to be collected, but it's going to have to go through the courts. So now FedEx and XYZ, other name a company that's going to sue the federal government here, is going to basically have to push this ruling all the way back up to the Supreme Court to get clarified.
What do you make of Trump's response? He seems so in denial about the ruling that he is almost like vindictive about it, like they're going to have to go to court. And yeah,
I think that a lot of Trump's agenda has been built on these tariffs. I can't imagine Trump is anything but absolutely furious over this. And then, now he's got these new tariffs. He's got 150 days to either determine that he can pass these through Congress and get them to, or figure out some other kind of workaround. We'll see. 150 days is what, 5 months?
Yeah, but it's just not going to work because his negotiating style is to be bombastic and be unpredictable. And if you have to push legislation through Congress, talk about telegraphing your move. You're never going to be able to have the element of surprise. So I just think the whole thing is kind of neutered. I don't know what else to say about it. So
here's the big question on that. Like when a lot of what you looked at in the stock market for last year was, and we've talked about this, the money flowing out of the U.S. and over into other countries, and we've talked about how the U.S., like our stock market is something like $60 trillion. The rest of the globe is not that big. So to move trillions and trillions of dollars out of the U.S. and move it into things like emerging markets and European economies, I mean, these markets can move really, really quickly.
Yes.
And last year we kind of started to see that, like this slow but definitive push of money kind of out of the U.S. system and into the global system. So we saw developed international outperform, emerging international outperform, all of that. Like, what do you think this means for any of that? Like, does that actually reverse on this?
Now we're getting into some of this. What do you do about this Supreme Court ruling? I think that trade deficits are going to continue to happen. Obviously, they've increased a little bit.
Well, the U.S. is a global exporter. Mm-hmm. Like
technically, what happens is that
importer. I'm sorry.
We are quite literally taking in goods and exporting dollars. So we're sending out dollars, and what's happening in the dollar market is very interesting. The dollar is actually weakening relative to the basket of currency called the DXY. Mainly the euro, the Japanese yen.
This was the exact opposite of what people thought was going to happen when Trump got elected, by the way.
The dollar has been weakening. Last year weakened about 10% relative to the DXY. So that I think is going to continue, because what I see happening right now, granted, I'm looking at it more from the macro scale, but what's happening is these foreign countries that are taking in these dollars, they're going around, turn around and like buying assets with it. They're buying gold. They're selling dollars, which is what's causing the weakening of the currency, and they're buying other assets. And they're not buying treasuries. They're buying it looks like looking at the flows, they're buying gold.
A lot of gold, yeah.
Yeah, and commodities and precious metals and whatnot. So, I think that that's likely to continue. So I don't see, now again, this is not advice, people. So don't go out and put all your money in this stuff. But I think the gold run up continues. I also think that the countries that benefit the most from this are our closest trading partners, where it's going to be tough to justify hostile intent and unfair practices, like Canada and Mexico. So I think now might be a good time to buy some Canadian stocks, especially some natural, like gold miner stocks, or Canadian natural resources or something. I don't know. Again, not advice, people, but I think that it also helps most likely like Europe. It helps all international countries. And if you look at valuations, we got this thing called JP Morgan Guide to the Markets, which is great. One of these things that I want to show you here is the purple dots are where valuations are today for international stocks relative to U.S. And we're all below historical norms. The
U.S. has been very dominant for a really long period of time, and it seems like with the implementation of tariffs, that money has slowly but surely been pushing out of the U.S. and some of these other places. So when these tariffs got shot down, there's part of me that said, well, now maybe these other countries have a little bit more faith in the U.S. system and they're not as worried. But I don't know that that's really the case. I think that the U.S. is my concern is that if we can't provide a level of certainty in like our policies as a whole, then it's hard. I think if I was somebody that's managing, billions of dollars of assets for some other foreign government or whoever's moving this money around, am I all of a sudden a lot more excited about allocating dollars to the U.S. now because of the Supreme Court ruling? I don't know that I am.
No.
So in fact, that's kind of what we've been seeing. So I put up on the screen the iShares Core MSCI. This is basically total international stock. It's like all stocks in the world except for U.S. stocks. It's up year to date. We're only 2 months into the year. It's up 10.24%. So it's already up almost 75% of the performance that the S&P achieved last year. So do I think this is going to continue? Yeah, probably. Now, the stock market is very unpredictable in short periods of time. So in the next 6 months, anything goes. I do not know what's going to happen. Nobody does. And if they claim to know, they're just trying to get your attention. They're baiting for attention.
Well, let me give you some hard numbers here just to kind of drive the point. If I go look at various assets since April of last year, April 2nd, which I believe was Tariff, the Liberation Day, as we called it. You have U.S. stocks have done well. U.S. stocks measured by the S&P 500 up about 24%. Developed international up about 34, so an extra 10. Emerging markets, so China, India, Brazil, up like 44%, and gold up almost 50%.
Yes.
So it's not to say that the U.S. the U.S. isn't going down, but like the relative performance has definitely shifted.
We're going through a global rebalance. We're going through a global rebalance, and now's a good time to look at that large cap growth portion of your portfolio and just think to yourself, should I diversify? I think that's what investors should be doing right now. Is they should be looking at their U.S. holdings and probably trimming a little bit, taking some of the chips off the table.
Just certainly making sure that you've got, for years, my entire career as an advisor, people have laughed at international stocks.
Yeah.
Like you show people a diversified portfolio and you say, hey, 15% of your portfolio is in international companies. Like people hated it. They didn't want to touch international. Why would I own anything international? I live in the U.S. I consume things in dollars. We have the greatest economy in the world. Why would I own international? And for 15 years, they were totally right.
Yeah.
International just lagged, for lack of a better word, for a long time. I can go pull some numbers here in a minute. But all of a sudden, things are a little different, and people are really happy they have that international. It's just a good... I think one of the things that people don't really appreciate, well, maybe they don't understand fully about diversification. Diversification means that at any given time, there's always going to be something in your portfolio that you are happy with and something that you're unhappy with. That's how diversification works.
Yes.
If you are really happy or really unhappy with everything in your portfolio, guess what? You're not diversified. Right? So having a diversified portfolio means we own U.S. stocks, we own international stocks, we own big stocks, we own small stocks, we own bonds, we maybe even own some other assets, other asset classes. And yeah, there's going to be periods where, oh, I'm really excited about my U.S. growth stocks, but why the heck do we own that international stuff in here? That was a bad idea. But there's going to be other times where that flips.
Yes.
And I think it's just so easy on a short-term basis to forget that like these different components of your portfolio, each one of them has a role to play.
Yeah, like that international component, it did absolutely nothing for you for 10, 15 years, and now it's carrying you across the finish line. Also, I wonder what are small mid caps doing right now?
Oh, they're also doing well. Really, what we've seen at the beginning of this year is like an everything but tech rally. Okay, you and I looked at this earlier. Consumer staples that were for the entire January of last year to January this year, basically up 3%, have ripped 16% in the last month and a half. The S&P X Mag 7 positive 4% compared to the S&P flat. Like it is kind of an everything but the Mag 7 and tech rally, but it's also important to note that if you are an index investor and you just own the S&P, you still like, yes, there's concentration in the Mag 7, and yeah, concentration can impact relative performance, but there are other companies in there. It's just the Mag 7 is down 10% year to date. The S&P is flat.
Yeah, the Schwab Mid Cap ETF I'm looking at is up almost 10%. You're about 9.18%.
But again, mid caps, if you looked since 2020 to 2025, mid caps had lagged.
Yeah, nobody wanted them.
Last year, if I was telling you about your mid cap in your portfolio, you're saying, "Hey, Brent, why did I underperform the S&P?" And the answer was, "Well, you don't own, the mid caps."
I feel sorry for the people that bailed on it, because it was really tough to hold that stuff. It's really tough. That's the problem I think that exists with index investing is indexes have they have potential to go through long, protracted periods of do nothing, and you have to be resilient during those periods. So it's just so tempting to bail out of something that's underperforming and get disheartened and just sell it and move into the things that do well. How often do you meet with clients and they base their entire 401k allocation off of the performance data?
Oh, yeah. I mean, that's how everybody.
Yeah.
I took phone calls at Fidelity for years with people trying to pick their investments and asking thoughts. And I said, the one question you would ask, how do you pick these investments? And people would say, well, I just look at the performance.
Just as a side note, you know what it is?
Let me just to drive home. I told the listeners I would pull this up. So from 2000 to 2025, okay, the S&P 500 returned 427%. Developed international stocks, okay, were up 94%.
So U.S. stocks were 4x.
4x.
Yeah.
And emerging market stocks were up 45%.
Yeah.
So now, if I ran this same thing, from 2025 to now, obviously we went over those numbers before, but it was not, I mean, that is a 25-year span where you're watching U.S. stocks crank 400% as you're sitting there more or less flat. I mean, I would say doubling your money over 25 years, which is what you did in developed markets, was pretty terrible, to be honest. I mean, there's a rule in our industry called the rule of 72. It says if you take the number 72 and you divide it by your rate of return, you get the number of years that it takes to double your money. So if you return 7.2%, 72 divided by 7.2 is 10. You double your money in 10 years. So how bad do your returns have to be for it to take 25 years to double your money? I mean, do that math. It is a crap return.
Yeah,
your return was basically the inflation rate being in international investments. Now, picking the moment that paradigm is going to shift is really, really hard.
Well, it's funny.
Okay, but it may have happened.
So just as a side note here, when I first got into the business, it was 2006. Everybody was investing international. If you didn't own 50% of your portfolio in international, you were a moron. I remember looking at the Oppenheimer Developing Markets Fund. I forget what year it was, but it had a 10-year average rate of return of 18% per year.
You want to know how that all looks? So from October of 2000 through 2006, when you got into the business, I'm just saying, U.S. stocks returned negative 0.34%. So the 6 years from 2000 to 2006, U.S. stocks are flat. International stocks, you want to know what they were doing?
They're positive.
Positive, almost 36%.
Yes.
So it just drives home the point that people love to chase returns.
Yes, they do. So, and if you invested in that fund at that peak 10-year mark, you would have spun in the mud for the next 10 years. The returns, I remember, were miserable. The point we're trying to make here is not to put all your money in international equities. That's not what we're saying. What we're saying is, we told you so. You need to stay diversified because you don't know what's going to outperform. And as a planner, what we like, we're kind of allergic to variables. The less variables we have in your plan, the better. We want consistency over high returns. I think people these days, and this bleeds into why everybody's opening up Robinhood accounts and they're trading meme coins and meme stocks and God knows what else. And now they're getting into prediction markets because they're looking for quick, easy money because they want to make so much money that the rules no longer apply to them. We live in a two-tier society, in my opinion. I think you've got the mega dollar society, we call it the 1%ers, and you got everybody else. For the 1%ers, let's face it, the rules don't really apply the same. Yeah. And I think everybody wants that level of freedom. So in their moments of desperation, they say to themselves, well, I'm not going to get that working my 9-to-5 job, so I better go, play the roulette wheel.
Kind of the
and
get rich quick scheme, and that stuff is generally not.
And I'm going to tell you right now, that is such a waste of time because people that get to that level in our society, that doesn't bring them any additional meaning. Your meaning is not in your money and the total volume, the number that shows up in your bank account is not meaningful. And I'm going off here. We're meant to talk about tariffs, and here I'm talking about the meaning of life. So I'm a little bit off base, but I do want to end on that note, and then we can move on to the tip of the week. And that is, keep your plan simple, keep it as predictable as possible, but more importantly than ever, have a meaning around your money, have a purpose.
Yeah,
and
I think there's a phrase for this: is give every dollar a job.
Well, yeah. And if you do that, you're less desperate, and you're not going to make these like Hail Mary bets, putting all your money in the S&P or putting all your money on Micron or Nvidia. While yeah, that's fun to do with a little bit. And if you get a big hit, nice, maybe you can take your wife or girlfriend out for a nice dinner or something. I don't know. But don't try to do that with all of your money, just in some desperate attempt to get a huge fat wallet so you can just go flex around everyone. That is so pointless. You're going to end up unhappy, I think, Yeah.
Well, what I've found in working with clients is that people a lot of times try to do that because they're trying to seek a level of control in their life. People see money as the most obvious way to gain control, because if you have a big pile of money, you can kind of do what you want. Like you can connect those dots.
Yeah, the rules don't apply to you.
And I think when they don't kind of see a path, there's this need to try to like game it. I think when from my experience, when we run financial plans with clients, and we can really help people take a step back and show them, hey, with consistent saving and investing, and even if you just get, I always laugh because I see these Facebook things periodically that says your financial advisor says that you're only going to make an 8% per year return. To heck with that. Let's make 20% a year kind of thing. But if I show you the math on how much money you're going to have if you make an 8% return and you just save consistently, you will be blown away. And it's a much more, if you make income, live within your means, save regularly, invest your money in productive, natively scarce assets, and you insure the risks that you can't control for. It's kind of hard not to end up in an okay place.
It's a simple formula.
We've worked with so many people. I could go on the list. You talked the number one. If I were to sample 1,000 clients, and I went and segmented the wealthiest people of those clients, and I asked those people, why are you so wealthy? What contributed to the level of wealth that you have today? I would be willing to bet that the vast majority of them, the reason they have the money they have is that they stayed invested and they were consistent with it. I know people with millions and millions of dollars that saved maybe tens of thousands of dollars over time, but because it was over a long period of time, there was consistency. We help them retire at 55. We help them retire earlier than they would have planned, with more money than they would have thought. And when we look back and we go measure like what return did it take to get you here, it's like 9%.
Well, that's a great way to put a cap on the conversation. I think we should move on to the tip of the week. Are you good for that?
You lead the way.
All right, we had a tough time with this one. So we try to come up with creative tips of the week, and sometimes it's more difficult than others. There's really not a lot of great sales going on right now. So,
President's Day sale.
Yeah, my wife wanted to buy a coffee roaster on President's Day. Couldn't find one. Nothing for sale. So anyway, yeah, President's Day. Apparently that's the time to buy mattresses. That's when you want to buy mattresses present. So there's your tip of the week. Wait till next year's President's Day and buy a mattress. I will say we did buy a mattress for my son, and we got from the original mattress factory. It was the best deal, and they had a delivery fee of only $50. I was like, sold. I don't have to buy get a pickup truck and rent it.
I think on large furniture, delivery fees are so worth it.
That should be the tip of the week, honestly. Spur of the moment tip of the week. Pay the delivery fee to have furniture delivered.
I know that we've ordered stuff from Pottery Barn for our house.
Yeah.
And I used to go, this is so funny actually. We got a lot of our furniture for our last house from IKEA. And I remember going and buying this stuff. And in IKEA, the way that you shop is you go through the display and you take a note of everything that you're going to buy. And then at the end, they have this giant warehouse, and you go find the box and put it on your pallet and then check out. And of course, it's this box and everything's in parts and pieces. And I'm a money guy, so don't discredit me for not being handy. But any piece of furniture I've ever put together from IKEA, I always do it wrong. I do something wrong in the instructions, and inevitably I have a dresser where the top drawer doesn't pull out, or it sticks or whatever. And I've spent hundreds of dollars to have a cheap piece of furniture that's halfway broken. So when we got our new house, I kind of turned over a new leaf, and I said, we're just going to go to the furniture store, the nicer furniture store, buy some stuff, and they're going to deliver it. So we go to Pottery Barn, and I've got them delivering furniture, and it's amazing. I stand there in the room, I tell them where I want it, and they put it together for me. So it is definitely a luxury. If pinching those pennies were what was going to make or break my financial plan, maybe I'd look at it differently. But if you have the money, back to planning, if you run your financial plan and you're confident that, maybe you don't love spending the extra money because your natural tendency is to be frugal, but you can spend the money. You're saving. You're still being responsible and taking care of your broader plan. Start thinking about ways to buy back your sanity in life. And if that's putting furniture together, great. But I think that can come in a lot of shapes and sizes for people.
Yes, actually, I'm going to call a small audible and the tip of the week here. Something that kind of took over like wildfire in my friend group was this process of roasting your own coffee. So, I'm a coffee snob. I like single origin and, like Folgers to me, you might as well give me cigarette ash. I don't like it. I'm too picky. So we have this roaster at home. I'll put it up on the screen. It's this coffee roaster. It costs $334, but it's a workhorse. We just put a couple ounces of green coffee beans, and you can buy green coffee beans right on Amazon. You can buy like these single origin. You can find some that we've ordered in bulk. Just go look online for green coffee, and you can buy them from Ethiopia. You can buy it from Brazil, wherever you like. And then it just comes. And you could just put it in like a freezer or just a storage closet and just roast it whenever you need it. You basically
Don't you have 4 kids?
Yeah.
When do you have time for this?
It doesn't take any time at all. You just do it on a weekend. So you wake up Saturday morning, you just throw a few ounces, you just put a measuring cup, throw the few ounces into this coffee roaster, you turn on the roaster, and it roasts your coffee. You come back in 30 minutes, and there you go. You got some freshly roasted coffee.
What does it end up? I'm always very cynical about financial advisors telling clients to spend less money on cups of coffee.
Yeah.
Like that's going to materially make you a millionaire or something. Like, does this save you money? I mean, like how much less do you spend on coffee?
It would save you money if you buy artisan coffee. Like here in Cincinnati, we've got this coffee. It's great coffee. It's called Deeper Roots, and then there's also Counterculture. So these are great coffee brands. By the way, another side tip of the week: Deeper Roots coffee, unbelievably good. All right, so we'll stop on that. So for those of you who are coffee lovers, give it a whirl. It is a little bit pricey, $334. So if
how many cups of coffee do you have to roast yourself before you've paid for the coffee machine?
I would say you probably have to use this for a year before it pays for itself, because you got to think about the green coffee as well. Green coffee is a lot cheaper.
Yeah.
It's a lot cheaper to buy.
I just bought my impulse President's Day sale purchase was this Rise mushroom coffee. So I don't know. I keep saying we all pretend like we're not victims of advertising, but you send me enough Facebook ads, eventually I'm like curious. So we'll see. I'll report on here if it's any good, if I get the mental clarity and magically lose. That
might be next episode's tip of the week. So stay tuned.
Or I'll tell you if it just absolutely tastes like dirt.
There we go.
Which is my fear. We'll see.
Well, thanks for everybody for listening. That's today's episode 51. So another 49 to go, and we'll be at episode 100, and we'll have to have some sort of celebration. So thanks for sticking with us this long. Catch you next time.
Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.